Welcome back to Morning Markets on Friday, the 22nd of September. Yesterday, the Bank of England held interest rates. Was this the final hike? Stay tuned for our perspective. So after 14 consecutive hikes, the Bank of England decided to hold interest rates yesterday at 5.25%. This was a majority decision at the Monetary Policy Committee, 5 members to 4 voting in favour of remaining. The market was surprised by this. The market was expecting another 0.25% increase to actually come through, given that core inflation is running at 3 times the Bank of England's target, and it's proven difficult to actually bring it down to that target. In terms of the market reaction, if we look at the bond curve in the UK, the front end, which is much more sensitive to interest rate expectations, initially moved lower, but through the course of trading, it did actually just revert back. So relatively flat on the day, 2-year gilt yields at 4.8%. The longer end of the curve, which is more sensitive to inflation and growth dynamics, started to move out. Moved out about 7 basis points on the day to a level of 4.7%. So some of the inversion of the curve did move out. If we look at the pound, it remained weak relative to a basket of international currencies, relatively unchanged versus the dollar, but slightly weaker relative to the euro at 1.15 on the day there. In terms of inflation dynamics, just to recap, earlier in the week we were discussing the latest headline and core prints. Headline inflation is running at 6.7% over the last 12 months. And if we look at core, that's 6.2%. So as I say, more than 3 times the current target of the Bank of England. And if we look on a month-to-month basis, then over the last 12 months, it's averaged around 0.5% in terms of those monthly increases. To achieve the target, they need to be below 0.2, so there's still quite a way to go. What does this mean in terms of as we look ahead? Well, we do anticipate that inflation is going to start to come down at a quicker rate here in the UK. At headline level, which captures energy, the energy price caps which commence from October will have an impact on that. In terms of core inflation, it's largely going to be the result of base effects. So the higher inflation prints that we've seen over the last 10 months start to drop out of the month-to-month reading. If we look at the pathway for interest rates, then at this stage the market is currently expecting there could be another 0.25% increase left in the tank this year should inflation not come down at the rate which is expected, which would take rates to 5.5%. The Bank of England have acknowledged that they are likely to hold interest rates sufficiently restrictive until that 2% target is in sight. If we look at their projections at this point in time, they do believe that they can hit that target by the beginning of 2025, but we'll keep you up to date on all of these inflation developments. So holding for now, potentially one more in the tank. Inflation is remaining pretty sticky here in the UK, but we do see prospects which will move inflationary pressures down further at this point in time. Thank you for watching.